In this video, I'm going to talk about National Express and give a stock analysis on the business and also answer the important question of whether you should buy National Express right now. Disclaimer, I'm not a financial advisor, and if you seek financial advice, please see a licensed professional. Firstly, I'm changing up the series. This means that stock analysis will be on a weekly basis. So please, the suggestion for the next video, drop it in the comment section down below and we'll get these going each and every week. And don't forget, the most popular one will be selected for next week's video, and don't forget to drop me one of these for the YouTube algorithm. National Express is a public transport company that provides public transport services across many of the continents except Australia and a large part of Asia. NEX owns and leases buses, coaches and also trains, in which they are used to help transport the public. But don't get me wrong, they also offer business services such as fuel distribution. They currently have a fleet of approximately 31,700 vehicles, 51,200 employees, and also a market capitalization of only £720 million. They're currently trading at a negative price to earnings ratio, which tells us that NEX is currently unprofitable. So we can't use conventional manners to value this company, but instead we can look at a price to book ratio. A price to book ratio is calculated by getting the market capitalization, which is the total amount of shares, times the share price value. And then you subtract the net asset value, which is assets minus liabilities, to get that. So what we will find is that the price to book ratio of National Express is 0.5 times, which compared to the market of 1.4 times would suggest that this stock is actually undervalued. However, you should also look at the industry, in which simply Wall Street suggests that the industry is also 0.5 times. And so I believe that investors are pricing in this industry the capital depreciation of these buses, coaches and trains, as for instance they do lose money over time due to being outdated, and therefore the investors are less willing to pay a premium on a stock that has a lot of vehicles that could be depreciating assets. Typically when I look at a company, I like to see how well they are able to generate profits using shareholder equity. This is also known as return on equity. Currently, since they are unprofitable, National Express only generate a minus 0.9% return on equity. However, if we use an article from a year ago which states that National Express actually had a return on equity of 13%, this is quite promising for this company. It's not insanely high, it's not a growth stock, and it's very likely that debt skewed this metric, but it's not bad considering the sector that they are in and that it seems like just a very defensive stock. However, National Express is unprofitable. So let's find out why by jumping into their half-year results published in August 2020. And unfortunately, due to the pandemic, they had an 80% slump in the number of passengers that they had aboard their services or fleet. And also that the costs of adhering to the virus and therefore having policies against it so that they can adhere to legislations has meant that they've actually had a lot more expenses than usual. This has pushed them into loss-making territory, and you can see this with their profit margin. At the end of 2019, they had a respectable profit margin of 5.1%, and now halfway through 2020, they only have a profit margin of minus 0.8%. So yes, it is down, but we do need to respect that it could be a lot worse, and subsequently the profit margins could be a lot lower. So this shows me that National Express have a very resilient business model, and that in the future that they could, once the economy starts to reopen up and strengthen, that they could actually adhere to these social distancing policies, as it seems like they don't have to have a passenger in every other seat. For instance, they could have them appropriately spaced out, and likely, yes, they will have lower profit margins, but subsequently still break even, or if not, make money. And despite the fact that in the last year, National Express had negative earnings growth of minus 113%, NEX still had a revenue for the first half of 2020 that was higher than the first half of 2018. And 61% of you aren't subscribed. It doesn't cost a penny and it is free, so please consider subscribing. Thank you. Since National Express is unprofitable and subsequently losing money, does this put their dividend at risk? Well, unfortunately it does, and in fact they've actually suspended, they had initially cut and now suspended their dividend so far, and honestly I don't expect this to be resumed until 2021. However, in the past 20 years, not including this year, they had managed to pay a dividend in 19 of those years. However, in 2008, in the deep part of the financial crisis, they had cut their dividend and then the following year in 2009 suspended it, which had meant if you were invested in that time period and you were really dependent on the payments, that this stock really wasn't putting it out for you. And therefore, whilst yes, it did have a strong history, it's maybe not the most reliable in recessions. But despite National Express cutting and suspending their dividend in 2020, this is actually good for shareholders. And you may think, why is that? I'm not receiving my income. Well, it allows the company to survive longer and it allows them to build up their cash reserve. Because if they'd have kept paying their dividend, they likely would have had to have taken up more debt to pay you, and which that's not a good thing. The more debt they have, the greater the risk of them defaulting on their debt and subsequently unable to pay down their debt, and therefore they're going to likely go into bankruptcy or administration, which would subsequently mean that they would need to either sell a lot of their assets to pay off the debt or simply go bust. So long as they return to profitability in a timely manner, we can expect the dividend to be resumed. But as I said earlier, I do not see this happening until the end of 2021, and that's simply because the travel sector is the hardest hit from the pandemic, and therefore there will likely be reduced travel for the next few years. Yes, they will likely start making profit again, but there is no need for them to start paying a dividend when they could really consolidate their business and pay down debt. This was never a high growth rate stock for their dividends. It was typically increased from around 2 to 10% each year, but they were a high yield of around 4%. So it was more or less a staple high yield stock that you would have in your portfolio to give you that needed income. And they would have typically paid in September and May each year. Is National Express at risk of defaulting on their debt? And how is their balance sheet in this time of uncertainty? Well, National Express aren't in a great financial position. This means that their short-term assets do not outweigh their short-term liabilities or their long-term liabilities. This is combined with the fact that they have a high debt-to-equity ratio of 122%. This means that in the very near-term future, it's very likely that they will have to raise capital. However, what prolongs this is that they do have a strong cash position in which it takes up around 1/3 of the total debt. Meaning that yes, they will have to raise capital, but perhaps in the short to medium term. But don't get me wrong, they have also diluted their share pool. And in 2013, they had actually released 100 million new shares. And whilst this isn't great for the shareholders, I see it as more of a positive. Since the amount of the share pool has increased, therefore the value of each individual share has decreased as well because there's a greater supply. But this means that the management are able to sustain their business and therefore survive longer. After all, you would rather that your business lost money rather than completely losing everything, right? One of the most positive things for this company is the strength of their management. And now they're sitting on a cash position of £586 million. It's certainly a stronger position than many of the other companies severely affected by the pandemic. However, there are some concerns that the rest of their debt is not well covered by their cash flow, and the fact that they're unprofitable means that they really will struggle to pay this down if they do not return to profitability soon. And I feel that this places a lot of risk in the investment currently, and you may see that NEX is down 75% year to date, and you may think, well, that's fantastic value. I could buy now, it must rise. Well, this is not always the case, but it could be a good value for investors. But as I said earlier, they had diluted their share pool by 20.2%. And honestly, I think it accurately represents and prices in the risks of the company that we know as shareholders. Evidence of the management actually being high skill is also the fact that they are targeting to reduce their gearing, which is their debt. Typically, it was around a ratio of around 2 to 2.5 times, but they're planning to reduce it to 1.5 to 2 times. This is a step in the right direction for the company, and they plan to lower this to this target allocation by the end of 2021. Hence my reasoning for why I don't think the dividend will be resumed before then, as they are focusing on reducing their debt, which I think is an excellent strategy for the business. I think that in the medium to term future, they do have a good business plan. If you'd have owned National Express in the last 5 years, you would have gotten returns of minus 52.9% with dividends reinvested, which is compared to the market of 19.3%. So it hasn't performed too well, but then again, the market is only down 20% year to date, and National Express is down 75% year to date. I personally believe that if you're considering to invest in National Express, you need to look beyond the short term and therefore think where you believe this business will be in the next 3 to 5 years. In my personal opinion, I strongly believe that as the pandemic starts to ease, that travel will start to increase. And this is the idea that as a majority of the population begins to get infected, we will start to build herd immunity. It will not be an instant process and will probably take many, many years. But once we eventually get over the threshold of 95%, that means herd immunity can really kick into place and reduce the total number of cases. This is also compounded with the idea that a vaccine may be in the pipeline, and in the next 1, maybe 2, 3 years, a vaccine will be available. And I feel that the demographic that will need the vaccine are those that are highly at risk of the virus. And subsequently, I also think that's the exact same demographic that will actively be traveling using coaches or buses. And once more, I strongly believe that the market has priced in the risks extremely well for National Express. And it does seem like there's little to no hope from the investors of this stock. Although I do feel like it does present an opportunity, as it is heavily priced down in the short term. And I think that in the next 3, 5, maybe even 10 years, that they will not be in such a bad situation. And in fact, I think their business model will adapt for the future. And that once they do recover, they will come out of this a stronger company. And I think it could be fantastic timing to buy in now, as they are struggling. And as it is famously said, buy when there's blood in the streets. This is a company that is struggling a lot. They have high debt. It's a high risk investment. But you buy now and you could be handsomely rewarded. However, if I was interested in opening a position with this stock, I would strongly suggest not putting lump sums of money in and not chucking all your money on it right now, but instead over each and every month, small consistent amounts of money into this stock and slowly let your position build up, so that if it drops another 15% on the next month, you've not lost that much money and can pick up more shares for a cheaper price. But even as it starts to rise, you're likely still going to be getting an excellent deal, as it has a long, long way to go up before it reaches its all-time highs. And this way, you're not trying to time the market by hitting the bottom, and it does protect you from potential downside. But personally, this stock isn't for me. I feel that the travel industry has too low of profit margins, very high competition, although against that, yes, they do have strong moats. And plus the idea that they're planning to lower their debt means that someone that's very interested in dividend payments won't be receiving one until probably the end of 2021. And even when they had dividend payments, their growth rate wasn't up to the standard of companies I look for. I typically look for high profit margin companies with high dividend growth rates. This simply isn't that company. Regardless, I do feel that this would be an excellent fit for someone in their portfolio looking for diversification into the travel sector, but doesn't want to purchase the likes of cruise liners, as they are extremely volatile and I would say a lot more risk than National Express. And personally, if I was interested in investing in the travel sector, as a UK offering, I think National Express would be my choice. If you're interested in my trig stock analysis, click the card at the top right of the video. Thank you for watching. I'm Osborne Foreman. Have a great day.